Morning, lovely learners and educators who are with you. I am Tello Mutloung, the subject advisor for accounting in the Mputsanyana district. Today, we'll be continuing with the ratio analysis. Yesterday, you dealt with the liquidity ratios with Mr. Mukwazi, and today we are continuing with the analysis and interpretation of the financial statements. But we'll be looking particularly on the profitability ratios, rather the profitability of the company. The analysis are very important as it forms an opinion or helps one to form an opinion on the results of the company. What I want you to understand is that it's very important for you to understand that in ratios, we follow the route for the 3 C's. One, you must be able to calculate a ratio. You must be able to calculate the ratio. After that, you compare it. It will depend whether you are given the information for 2 companies or you are dealing with 1 company but given 2 different years. If you are given the 2 companies, then you must be able to compare the results that you got when you calculated the ratio with the results that are given to you as information of another company, meaning you'll be comparing the ratios for 2 companies. But if you are given 1 company, then you'll be given 2 results for 2 different years. Therefore, you must be able to compare the results that you got, that you calculated, and the results that are provided to you or that are given to you as an information. Immediately after comparing those results, you must be able to comment on the results that you have calculated. Are you seeing a decline when you compare the ratios, or has the ratio improved? Is that good or bad for the business? But we'll also look at the reasons, and is it good when it goes up or is it bad when it goes down. But we'll go into details and see on those ratios. But it's very important that as a learner, you must be able to calculate those. And if you calculate this, then what is important is the formula. It's very important that you know your formulas. And when you compare, I've said you must compare. Either you are given the information for 2 companies, or you are given 1 company with different years that you must compare. Then in your comment, you must be able to say whether the results, as you compare them with the previous year, are they good for the business? Should the shareholders be satisfied, or should the owner be satisfied with the portion that is coming to the business, and so on and so forth. Right? The profitability of the company. Here we look at how profitable is the company. How well does it control its expenses, and how efficiently is it operating? In other words, we look at the cost control of the company. Profitability ratios show how much profit. Profitability ratios show how much profit the company takes in for every rand of sales or revenue. We are going to compare this and look at how much are we making, the money that comes in the business for every rand of sale. These ratios are also used to assess the business ability to generate earnings as compared to expenses over a specified period of time. It's very important that we understand that these ratios, we use them to assess the ability of the business to generate earnings as compared to expenses over a specified period of time. The information relating to the profitability ratios is extracted from the income statement. It's very important that you know the source of your information so that you don't waste too much of your time in the exams going through the question paper, the entire question paper, looking for information to use in a particular ratio. But I'm saying to you, for the profitability ratios particularly, you are going to take the information from the income statement. Then we'll look at the following ratios. Today we'll look at the following 4 ratios. the gross profit as a percentage of cost of sales, the gross profit as a percentage of sales, operating income as a percentage of sales, net profit after tax as a percentage of sales. These are the ratios that we are going to look for, that we are going to look at in determining the profitability of the business. When calculating the gross profit as a percentage of sales, net profit as a percentage of sales, and gross profit as a percentage of cost of sales, we want to determine whether the purchasing policy, the sales policy, and the markup are as per management policy. These three ratios, whenever you calculate them, what you normally want to prove or determine is whether the policy regarding to the purchases, the policy regarding to the sales of the business, and the policy regarding to the markup are as per the agreement or as set out by the management of the business. Then when calculating the net income as a percentage of sales, we determine the specific income of the business and the overall performance of its operating, financing, and investing activities. It's very important that you understand the ones that are dealing with the gross profit of sale, the net profit as sale, and the gross profit as a percentage of cost of sales. There, we only want to determine the purchasing policy, the sales policy, and the markup as per management policy. Then the one that deals with the net profit after tax, we want to determine the specific income that comes into the business and its overall performance when you look at the operating, the financing, and the investing activities. It's so important that we look at these ratios individually. What we are going to do here thereafter are the profitability ratios. The first one will be gross profit on sales. How do you calculate it? It will be your gross profit divided by sales. You multiply it by 100 over 1. That's the formula for calculating the gross profit on sales. This ratio indicates how much profit is included in the sale of an item. When you calculate this profit, you want to find out how much profit is there or is it included in the sale of an item. Let's make an example. If you calculate and you get a gross profit of 20%, what does that tell you? This means that the company is making 20% gross profit for every 1 rand of sale. When comparing the results with the previous year, and the ratio drops, it's very important that you understand this. When you compare the results with the previous year results, and the ratio drops, then the following might be the reason. Please know that then there might be a problem with the cost control of stock. However, if it remains the same, the problem might be with other costs in the business, like administration costs, overhead costs, etc., etc. We normally say it is important that only when it goes up or when it increases, then we will say things are good for the business. Let's take this example. You are given the information that relates to Zebra Limited, the 2012 results. Now the 2012 information is that the sales is 800,000 and the cost of sales is 450,000. For 2013, you have the sales of 600,000 and the cost of sales for 350,000. Now let's calculate the gross profit on sale for those 2 years and compare our results. The formula, remember, it's gross profit over sales multiply by 100 over 1. Then you have the information for, you are going to calculate for 2 years. We are going to calculate for 2012 and for the current year, that is 2013, according to the information that is provided to us. For 2012, our sales is how much? You go back to the information given. Our sales is 800,000 and the cost of sales is 450. Now what do we want? We said we are looking for the gross profit. We say our sales of 800,000, we subtract the cost of sales of 450,000. That gives us a gross profit of 350,000. It will be 350,000 divided by sales of 800,000. We'll multiply that by 100 over 1, which will give us 350,000 over the sales of 800,000. You multiply that by 100 over 1. That gives us something like 43.75, we round it off to 44%. These are the results for 2012. We now move on to 2013. The formula is still the same. Let us calculate the gross profit for 2013. Our sales is 600,000. Then our cost of sales is 350,000. Then we will have the sales of 600,000. We subtract the cost of sales of 350,000, which gives us a gross profit of 250,000. Then it will be 250,000 as our gross profit over our sales of 600,000. You multiply that by 100 over 1. Then the result will be 250,000, that is our gross profit. We divide that by the sales of 600,000. You multiply that by 100 over 1. It gives us 41.6%, you round it off to 42%. It gives us 42%. This is for 2013. This is for 2013. Now, if we look at the result, our ratio declined from 44% in 2012 to 42% in 2013. It's a decline of 2%. It's a 2% decline. What did we say earlier on? We said when we compare the results with the previous year and the ratio drops, then there is a problem with the cost control of stock. However, if it remains the same, the problem might be with other costs in the business, like administration costs and overhead costs. But here the ratio dropped. It dropped from 44% in 2012 to 42% in 2013. Remember, the results prove that there are profitability problems in the business, which might be caused by the lack of stock control inside the business. When providing a comment to the results of the gross profit on on sale, you must attempt to provide answers to the following questions. Is this financial year result better or worse than the previous year? You must provide the answers to the questions that I posed there. As a company, are the results better in the current year or worse as you compare to the previous year? And the question will be, the results are worse. Because in 2012, it was 44%. In 2013, it is 42%. Therefore, the results are worse when you compare to the previous year. The other question, what could be the possible reasons for the change, for this decline? We said if the ratio is declining, then there is a problem with the cost control of stock. Therefore, the reasons that are causing a decline in this ratio might possibly be a lack of control or the problems that we have with the cost control in of stock in the business. Could the business increase sales and thus increase profit? You must also have that in mind. Will it be possible for the business to increase its sales so that ultimately the gross profit will increase? That will be a helpful idea if we move on to say we want to increase the profitability of the business. It might be important that the business start first by increasing the sales, then profit will ultimately follow. I'll also like to look at this example when you deal with the gross profit on sales. Let's assume that you are given the information as it is shown on the screen. Helen's hairstylist, the income statement. But now, I gave you the income statement for 2 years, the 2012 and the 2013. What you are supposed to do is to calculate the gross profit on sales for the 2 years, compare it, and comment on the results. I want us to work it on this one. I use the same years so that we avoid confusion. It will still be 2012, and our current year, the current financial year, will be 2013. Based on the information we said earlier, the information for the profitability ratios is contained in the income statement. Now for 2012, there is your gross profit, 52,500. It means for 2012, our gross profit is 52,500 over sales. How much were our sales for 2012? Our sales were calculated to be at 122,500. Then our sales were calculated to be at 122,500. You multiply that by 100 over 1, which will be the gross profit of 52,500. We divide it by the sales of 122,500. You multiply that by 100 over 1. Then your results will be 42,8 something. We round it off to 43%. It's 43%. Let us look for the 2013 information. We're still going to do the same. We are calculating. That is the first C. You are given the information for 2013 that your sales were calculated to be 105,000. So your gross profit were 45,000. Now let us take that into the formula. We have your 45,000 gross profit. You divide that by the sales of 105,000. You multiply it by 100 over 1. Then your results will be, it's 45,000 You divide that by the sales of 105,000. You multiply that by 100 over 1, which gives you 42 comma something, which take us to the 43. Round it off, it's 43%. What does it tell you? We said earlier, if the ratio drops, then there must be problems with the stock control in the business. But now the ratio remains the same. The ratio, it's the same for 2012, it's 43%, and even for 2013, it's 43%. Let us look at our reasons and remind ourselves of what we said. We said, if the ratio remains the same, like it is in this result, then the problem might be with other costs in the business, like administration costs and overhead costs. It says now the problem is not with the stock control. The stock is controlled well in the business, but now the problem lies with other costs in the business. We made an example of administration costs or overhead costs. Let us hope that we understand that. Just to do a quick recap, when you calculate the gross profit on sales and the ratio drops, then you must know that there is a problem with the cost control of stock. But if the ratio remains the same, like we did in the second activity, the problem might be with other costs in the business, like administration costs and overhead costs. Those should form part of your comment when you comment on the results of the ratios. Let us move on to the second ratio. That is the gross profit on cost of sales. The gross profit on cost of sales, I gave you the formula there. It's gross profit over cost of sales now. Remember, the first one was gross profit on sales. Therefore, we are dividing by the sales. But now we have moved to the gross profit on cost of sales. This ratio indicates if there is or there was a major change in the cost of goods sold. When you calculate this ratio, what you want to prove is that are there any major changes in the cost of the goods sold? I gave you the example here so that we do it on screen. You also took the same information like the first one from the Zebra Limited. We gave you the 2 years so that we are consistent. The 2012, and we are given the 2013. The sales remains at 800,000 and the cost of sales still remains at 450. For 2013, your sales, it's now 600,000. The cost of sales is 350,000. What is very important that I want you to understand is the following. When you provide a comment to your results, you must attempt to provide answers to the following questions. Is this financial year's percentage better or worse off than the previous financial year? What could be the possible reason for the change, if there is any change? Could the business increase sales and thus increase the gross profit? We have also added the other one. What is the business pricing policy? Because you are dealing with the cost of sales. You want to check what is the business pricing policy. Now, we take the 2 years as they are provided in the example. You have your 2012. You have your 2013. We have calculated in the previous activity that our gross profit for 2012 is 350,000. We can recap it, it's fine. The gross profit will be sales of 800,000 we subtract the cost of sales of 450,000. This gives us a gross profit of 350,000. Therefore, it will be 350,000 over cost of sales. Our cost of sales is how much? Our cost of sales is 450,000. We'll multiply that by 100 over 1. What are we trying to prove with this ratio? We want to see if there were any changes, any major changes in the cost of the goods sold. Now let us quickly find the answer. It will be your 350 gross profit. You divide that by the cost of sales of 450,000. You multiply that by 100 over 1. It gives us 77.77. We round it off to 78%. Now let us look for 2013. The 2013 sales were 600,000 and the cost of sales were 350,000. Let us calculate the gross profit. 600,000, you divide that by the cost of, you subtract the cost of sales of 350,000. Then the gross profit will be 250,000. For 2013, the gross profit is 250,000 over the cost of sales of 350,000. We will multiply that by 100 over 1. It's the gross profit of 250,000. We divide that by the cost of sales of 350,000. We multiply by 100 over 1, which will give you something like 71.42, that we take it as 71%. Then the importance. What is so important when calculating these ratios? I told you, is the financial year, the current financial year result better or worse off than the previous year financial year result? Last year, that is in 2012, according to the information we were given, it was 78%. Now it dropped in 2013 to 71%. We had a decline of 7%. We have a decline of 7%. Is the business on the right track? Meaning, were there major changes in the cost of goods sold? And here we are finding out exactly that there was a decline in the cost incurred in the cost of the goods sold. Therefore, the business is definitely in the right track. If you are able to decline or to reduce your costs or to keep them at a very minimal level without affecting any operations in the business, then you are definitely in the right track. Then we'll say it's a decline of 7%. What could be the possible reasons for the change, if there is a change? If the costs are declining, what could be the possible reason for that decline? It might be the business found a cheaper supplier, although we don't want to compromise quality. We must prioritize quality, but prices are not the same. Wherever you buy, prices are not the same. You must compare the prices. Always strive for a cheaper supplier, but make sure that you do not compromise the quality. It's very important that you give your customers or the consumers the best quality that they deserve. Now let us look at the following example in calculating the gross profit on cost of sales. I will use the very same years. The 2012 financial year and the 2013 financial year. We'll get the information from Helen's Hairstylist. You have the information for 2012 and you have the information for 2013. What are we calculating? We are calculating the gross profit on cost of sales now. For 2012, our gross profit was 52,500. It declined to 45,000 in 2013. Our cost of sales was 70,000 in 2012. Now in 2013, they are 60,000. Let us start first with the information in 2012, because we want to compare the results for these 2 years, 2012 and 2013. The gross profit for 2012, it's 52,500. We divide it by the cost of sales of 70,000. We will multiply that by 100 over 1. Where did you get the information? The gross profit is 52,500 from the given information. You are going to divide it by the cost of sales of 70,000. We multiply it by 100 over 1. Let us do the calculations together. The gross profit of 52,500, divide that by the cost of sales of 70,000. We multiply that by 100 over 1. It's 75%. For 2012, the gross profit on cost of sales, the profit we earned for the 1 rand we spend on buying those goods and services was 75%. Let's look for 2013, because our aim is to compare the results, the current year results with the previous year results. You have the cost of sales of 60,000 and the gross profit of 45,000. Our gross profit, it's 45,000. We divide that by the cost of sales of 60,000. We'll multiply by 100 over 1. It's a gross profit of 45,000. We divide that by the cost of sales of 60,000. We multiply by 100 over 1. It gives us 75%. Let me quickly take you back to the example I did with you. For this example, what were the results? The ratio dropped from 78% to 71%. That is the first thing that you do. You check if the financial year percentage is better or worse off than the previous financial year's percentage. Then for this activity, we found that it dropped. But for the example that we did with you now, there is no change. Gross profit on cost of sales is constant at 75%. The previous year, it was 75%. Even this year, it was 75%. What is the other question that you must answer? What could be the possible reason for the change, if there is a change? If there is any, what could be the possible reason? But for this activity, there is no change. Therefore, everything is still operating, or we are still using maybe the very same suppliers that we used the previous year, and the prices have not yet changed that much. Because we incurred a 75% gross profit, we got 75% gross profit on cost of sales, we are still getting 75% gross profit on the cost of sales. Could the business increase sales and thus increase the gross profit? That is possible. Every business will increase its sales if it wants to increase the gross profit. What is the business pricing policy? When you calculate this, you must also check at the business pricing policy. It might be we have also remained constant in as far as prices are concerned, and therefore that does not have a change in the gross profit. It means the gross profit as percentage of cost of sales is exactly what we got in 2013 and 2014. Therefore, one, if given the further information or any extra additional information, definitely one will have to look at the pricing policy of the business. Whether are we following the policy as set out by the management, or there has been a deviation in our policy. But what is interesting is, what is so interesting is that you also check at the cost of sales dropped from 70,000 to 60,000. So was our sales, and so was our profit. Although the cost of sales dropped from 70,000 to 60,000, and the gross profit drops from 52,500 monetary and to 45,000 in 2013. Our ratio proves that, but the gross profit we are earning on the cost of sales is still the same. Although figures might vary, or the money has dropped, what we spend on the cost of sales dropped as compared to 2013, but the ratio proves that what we got as a gross profit on sales is still the same as what we are getting as a gross profit on cost of sales in 2013. Let us do a quick recap. What do you want to calculate? Here, we want to indicate if there were major change in the cost of the goods sold. Were there any changes or the major changes insofar as the cost of the goods sold? And for the first example, we saw that it dropped, therefore there were changes in the cost of the goods. But the example that we just did now shows that there is no change. There are no changes, and everything is still the same. Hence, what we got as a gross profit on cost of sales, it's 75%, was 75% in 2012, and what we are getting as gross profit on cost of sales is 75% in the current year. I hope we understand each other. We just calculated the gross profit on cost of sales and the gross profit as a percentage of sales. What were we proving? when you calculate the gross profit on sales and the gross profit as a percentage of cost of sales, we want to determine whether the purchasing policy, the sales policy, and the markup are as per management policy. That was just a recap. We are moving on to the other ratio, operating profit on sales. This ratio indicates the operating profit for every rand sold after taking all the company costs into consideration. The result, therefore, differs from company to company. How do you get the operating profit? If maybe it's not given or you're not given the information, our operating profit will be profit before tax plus the interest paid. You subtract the interest received. This is the last portion of your income statement. You are doing a backward calculation. It's a profit before tax. Then you know you'll have income tax when you go down. Then net profit for the year. But before profit before tax, you'll have subtracted your interest expenses or interest paid. Then you'll have profit before interest expense. You'll have interest income. Therefore, your gross profit, operating profit, I'm sorry. This is the bottom part of your income statement. You'll have your profit before tax here. If maybe there is an information missing and you are not able to find your operating profit, therefore you'll take this profit before tax, you add the interest expenses, then you subtract the interest income, because you are doing a reverse calculation. You are calculating it going backward. We know when you go down, interest income is added, interest expenses is subtracted. But because you are calculating it moving upwards, that is the reversal entry calculation, you are going to take the profit before tax, you add interest expense, you subtract interest income, we are moving up. Then it will give you your operating profit. The example is taken from Zebra Limited. I wanted to use the same figures for the sake of consistency. 2012, we also have two. We'll use the same financial years, 2012 and 2013. The operating profit on cost of sales, on sales, I'm sorry. The operating profit on sales, it will be operating profit over sales. For 2012, our sales is 800,000. The operating profit is 70,000. 2013, our sales is 600,000. The operating profit is 50,000. What do we want to indicate? We want to indicate the operating profit for every rand sold after we have taken out all the company costs. This result will therefore differ from company to company. We have your operating profit. Operating profit over sales. We'll multiply that by 100 over 1. Our operating profit over sales, we'll multiply that by 100 over 1. Let us start first with 2012. The 2012 information shows that our operating profit amounted to 87,128. Let us start first with the one that is given here as an example. Let us start first with this one that is given here as an example before we move to the activity that I'm going to do with you. Our operating profit is 70,000. We divide that by the sales of 800,000. We multiply that by 100 over 1. It's operating profit of 70,000. We divide that by the sales of 800,000. Multiply by 100 over 1. It's 8,75, that is 9%. It's 9%. This 9% represents the operating profit for every rand sold. We're getting 9% on every rand that we sold after we have taken all the company costs into consideration. For 2013, your sales is 600,000. Your operating profit is 50,000. Let us take it to the formula. Operating profit of 50,000 rands. We'll divide that by sales of 600,000. Multiply by 100 over 1. Our sales is 50,000. Sorry, operating profit is 50,000. We'll divide that by the sales of 600,000. We'll multiply it by 100 over 1. It gives us 8,3, that is 8%. This shows us a decline of 1%. It's a decline of 1% from 2012 to 2013. It means the operating profit that we got for every rand sold has declined as compared to the previous year. Let me take a question. Is there a possibility of calculating the markup percentage and not state whether to calculate on sales or on cost of sales? Or how are we going to calculate that? That is from Tandega. Thank you very much for the question. If I understand your question clearly, when you calculate this ratio, are you saying will it always be stated whether to calculate it from sales or from cost of sales. That is true. You will be asked to calculate the profitability of the business or the gross profit based on either the gross profit as a percentage of sales or gross profit as a percentage of cost of sales. They cannot just say for you, calculate the gross profit, because you have to take gross profit and divide it by something. Therefore, they have to guide you. The question will have to guide you whether you are going to calculate your gross profit from the sales or whether you are asked to calculate the gross profit from the cost of sales. Let me go back a bit as a form of demonstration for what I've just said. And thank you very much, Tandega, for the question. Here, the first profitability ratio that we dealt with, you are requested to calculate gross profit on sales, because you must take gross profit and divide it by something. Therefore, the question will have to be clear to indicate that you are going to take gross profit and divide it by sales. Then the second profitability ratio that we dealt with was very clear, that calculate the gross profit on the cost of sales. Then we took gross profit and divided it by the cost of sales. Please don't worry if you are asked to determine the profitability. The question will always be clear as to whether it is profitability from the cost of sales or whether it is the profitability and on the rent we got from the sales. Let me summarize this ratio by saying the operating profit on sales declined from 2012, it was 9%, to 8% in 2013. It means the operating profit that we got for every rent sold has declined by 1% from the previous year to the current year, after taking all the company costs into consideration. You'll remember where we take the operating profit from the income statement. It is the portion, the operating profit, it is here. It means we want to look at the earnings of the business after we have taken all expenses into consideration. You'll remember that it was gross operating income of 214,000. We took out expenses. Let me just indicate it like this. We took out expenses to take us to the operating profit of 87,128. Therefore, this agrees to what I said earlier when I said here we'll have to indicate the profit of every rent sold after we have taken all the company costs into consideration. Therefore, the results for this will differ from a company to company. Now, what happens? You'll find that in other question papers, you are not given the operating profit. But if you are not given the operating profit, there must be additional information from the indicating to you or guiding you as to how you are going to get the operating profit. It might be they will say to you, operating profit amounts to 20% of sales. Therefore, you know that you are going to take 20% of this and it will give you the operating profit. But if that information is not given, therefore you must be given something like this, which will require for you, for you to go down, you will say operating profit, add interest income, that is zero in this regard. Then you will subtract the interest on loan. But let's say for obvious reasons or for other reasons, this was not provided. Then you are supposed to say, you calculate it upwards. That is the net profit of 86,628. You add, because you subtracted We subtracted when you go down. You are adding when you go up. You add the interest on loan of 5,500, I'm sorry. It will give you, because there is no interest income, it will give you our operating profit of 87,128. Like I said, that if you are not given that information, then you will take the profit before tax, you add interest paid, you subtract the interest received. It's a reversal entry. Thank you very much for this. Let us take a break, then we'll come back and finish up. Thank you very much and welcome back. Before we went for the interval, I've just calculated the operating profit on sales for the 2 years, 2012 and 2013. I'll always try to explain to questions as and when we move on. Now the question says, when calculating these ratios, now you find that the 2012 ratio, let's make an example that the 2012 ratio happens to be 9.2 and the 2013 is a straight 9%. Should we say the company is worse off, or should we just say it's a slight difference? I think it's important that we understand a decrease is a decrease. A decline is a decline, whether it is a huge decline or a slight decline. But for the worse off, we could say it's not that bad, but the most important part is that it has declined. It has slightly declined. Yes, we cannot say the company is so worse off, just a slight decline. So let me just say whether it has declined by a comma, a 0.1, or maybe a 0.2%. Let us agree on saying it has declined, regardless of by how much it has declined, but a decline should be a decline. The other question was, if we use sales, let's make an example of the one that we are still busy with, the operating profit over sales. Remember, I said earlier, let me refer you back to the statement, the information relating to the income state, the information relating to the profitability ratios is extracted from the income statement. Now, the question was, when we calculate these ratios, do we take out debtors allowances from sales, or do we take sales as it is? When you are given the income statement, we know that this sales does not include debtors allowances. On the statement, it will be sales minus debtors allowances. Then it will give you these figures. So when we are doing these ratios, we are taking the final figure of sales. Debtors allowances have been taken out already. This is what goes to the income statement. And these are the figures that we were using? I think that is a very good question. In case you are not given the information from the income statement, but you are provided with the information from the trial balance. Although it will not give you sometimes from a gross profit, you have to calculate it for yourself. But if let's say you are given the information that the sales amounted to this much and debtors allowances are amounted to this much, it's very important that what we take to the ratios is the sales in the income statement, and we know the sales in the income statement already, debtors allowances have been already subtracted from the sales that is captured in the income statement. I think I've answered those questions. I'll try to answer other questions as and when we move on. We're busy with the operating profit as a percentage of sales, and we calculated the one for 2012 using the example that is given to you, that in 2012 the operating profit was 9% and it slightly declined by 1% to 8%. Honestly speaking, it's a slight decline, but in accounting, a decline is a decline regardless of how huge or how small it is. The fact of the matter is the ratio has declined, and therefore in your comment you must indicate that the ratio has slightly, you can even say slightly, but it has declined. Now, using the information given to us, using this information given to us, we are also going to use for the 2 years, the 2012 and the 2013. Gross profit as a percentage, operating profit as a percentage of sales. That's where we are. Operating profit as a percentage of sales. Then the ratio for calculating that, this is 2012, this is 2013. We have operating profit because it's a percentage of sales, it will be over sales. Over sales, we will multiply that by 100 over 1. Operating profit over sales, we'll multiply that by 100 over 1. Now let us check our information. The operating profit for 2012 was calculated to be 87,128. Divide that by our sales for 2012, amounted to 122,500. We will multiply that by 100 and divide it by 1. It's 87,128. We divide it by 122,500 of sales. We multiply it by 100 over 1, which gives us 71%, meaning the profit that we earn from R1 of sale, after taking all the expenses of the business into consideration, was 71% in 2012. Because we want to compare for the 2 years, that is 2012 and 2013, we'll also calculate for 2013. We'll calculate for 2013 our operating profit. For for 2013 is 46,928. 46,928. We'll divide that by the sales of 105,000 for 2012. It was 105,000. We'll multiply that by 100 and we'll divide by 1. It's an operating profit of 46,928. We divide that by the sales of 105,000. We'll multiply it by 100 over 1. And it gives us 45%. 45%. It means, and as per this activity, that for every rand of sale in 2012, we got an operating profit of 71%. After we have taken out all expenses into consideration. Then that profit declined to 45% in 2013. It's a huge decline. But the fact of the matter is, it's a decline. Therefore, it has declined by 26%. It's a decline of 26% when we compare to the previous year. So we are saying whether it is as huge as it is in this activity or whether it's a slight decline. I think it's very important that learners, you should indicate whether it's a decline or whether it has increased, regardless of how slightly it has increased or decreased or declined. Let us move on to the other profitability ratio. Net profit on sales. I've taken to use the net profit after tax because taxes do not form part of the ratios, should be taken out of the ratios. This ratio indicates the overall performance of the business operating, financing, and investing activities. When we calculate this ratio, we want to determine for every 1 rand of sale, how much is the business earning? For every 1 rand of sale, how much is the business earning? The higher the profit margin, this is very important. The higher the profit margin, the more profit a company earns on each sale. When you calculate for 2 years and you find out that the profit margin is so higher, then it means the more profit a company is earning on each sale. The profit margin is mostly used for internal comparison. We are going to compare with the current year and the previous year within the same company, because it is difficult to accurately compare the net profit ratio from different entities. Our businesses are not the same, therefore the profit of the business are not the same, and the amount of tax that we pay is not the same. Therefore it won't be very accurately when you compare with other entities, but it is used internally as you compare the previous year to the current year. If the ratio declines, it could be due to the lower markup percentage. These are the reasons now. If the ratio is declining when you compare the previous year and the current year, and you find that the ratio has declined, it could be because of the following reasons. It could be because of the lower markup percentage, or expenses could have increased at a faster rate than sales, or it could be the interest on loan, which has an effect on the bottom line profit, or it indicates a low margin of safety and a higher risk that a decline in sales will erase profits and results in a net loss or a negative margin. Let us quickly go through it again. When you calculate the net profit on sales and you compare it to the previous year, and you find out that the one that you calculated for the current year represents a decline to what was given to you as the previous year ratio, then you must know it could be because of the following reasons. It could be due to lower markup percentage set out by the business, or expenses in the business could have increased at a faster rate than sales, or it could be the interest on loan. We know it has an effect on the bottom line of the profit, or it could indicate a low margin of safety and a higher risk that a decline in sales will erase profits and result in a net loss or a negative margin. You are given the information as an example here, extracted from the books of Rhino, the 2012 and the 2013. I will use net profit after tax divide by sales multiply by 100 over 1. It will be the net profit after tax over sales multiply by 100 over 1. Let us start with the 2012 information that is given to us. Yes, we are given that is 13%, and here it's 12. We just want to prove how did they arrive to those profit on sales. Our net profit is 40,000 over the sales of 300,000 in 2012. We'll multiply that by 100 over 1. The net profit of 40,000 divided by sales of 300,000. You multiply that by 100 over 1. Gives you 13.3, that is 13%, as it has been given to us. That is our 13%. Then for 2013, our net profit for 2013 is 48,000. We divide by sales of 400,000. Multiply that by 100 over 1, which will be the net profit of 48,000 divided by sales of 400,000. You multiply that by 100 over 1, then it gives you 12%. This is how they arrived at those figures there. Now what happened? Still in 2012, it was 13%. We have a slightly 1% decrease, a slightly 1% decrease. It means for every 1 rand of sale, the business was earning 13% profit in 2012. And in 2013, for every 1 rand of sale, we are now earning 12%. In order for Rhino to increase their net income, they may decide to reduce the prices of their products to stimulate sales. Although the net profit on sale has dropped by 1%, look at your sales. Your sales were 300,000 in 2012. The sales increased to 400,000 in 2013, as well as the net profit. It was 40,000 in 2012, and in 2013 it's 48,000. But maybe Rhino, because desperately wanted to increase the net profit, he reduced the prices of their products to stimulate sales. You can make a sale so that customers come to a business, and that will result in a lesser profit percentage, net profit percentage on sales. That when you compare what you are earning as the business, your sales might increase, the net profit might increase. But what you are earning as a business on every rand of sale will drop, because you reduced prices so that you stimulate sales. I hope that you understand that the scenario here, if you look at this, excluding the profit on sale, if you look at this, one will assume that no, sales increased from 300,000 to 400,000, and our profits also increased from 40,000 in 2012 to 48,000 in 2013. But what we wanted to find out was this: the percentage profit on sales. What happened? How much are we earning back as the business per every rand of sale? And the calculation shows that we are now earning 12% as compared to the 13% we earned the previous year. Therefore, we assume that the business, because they desperately wanted to increase their net income, they decided to reduce the prices of their products to stimulate sales. That action may lead to the results in 2013 as shown in the table above. That action that they took will lead to this, to the scenario that we have now. That although sales improved from 300,000 to 400,000, and the net profit improved from 40,000 in 2012 to 48,000 in 2013, but how much are we earning as a business for every 1 rand of sale? It indicates that whatever we are earning as a business has declined. Although Rhino have increased their net profit from 40,000 to 48,000, like I've explained, their net income compared to sales has declined from 13% to 12%. It is the prerogative of every business to decide how they are going to stimulate their sales. Therefore, Rhino in this regard decided to reduce the prices. Your normal buy one get one free, or buy two for the price of one, so that people will come, and that will increase the sales. In the eyes of the public and in the information provided to us, people will say the business is doing well because the sales has improved from 300,000 by a huge 100,000, and the profits only improved by 8,000. But how much are we earning for every 1 rand of sale? That has declined. What comes into the business as a percentage for every 1 rand of sale that we sold has declined by 1%. I hope you understand what I'm trying to explain to you. Let us take other example. Maybe it will clarify things more as and when we move forward. You will have a scenario like this. You will have a scenario like this. In 2012, the net profit amounted to 86,628. And in 2013, it declined to 46,303. Our sales were 122,500. They declined also to 105,000. Let us use this scenario to check the profit, to check the net profit as a percentage of sale. This is 2012. This will be our 2013. We'll have your net profit here. We'll divide it by sales. We multiply by 100 over 1. Net profit over sales. We'll multiply it by 100 over 1. Let us check the information as provided. You'll be aware that for 2012, the net profit is 86,628. 86,628. We'll divide that by the sales of 2012 because we are in the same year. We are using the 2012 information for now. That is 122,500. You multiply that by 100 over 1. Let us calculate it. Your net profit of 86,628, you divide by the sales of 122,500, you multiply it by 100 over 1. It will give you 70,7, that is 71%. It gives you 71%. Let us calculate the same for 2013 because we want to compare for the previous year. Remember I said for this, it will not be accurate if you want to compare it with other entities. But it is only used for internal comparison because you are able to compare what we have inside the business because companies operate differently. Our net profit for 2013 amounts to 46,303. We take it to our formula. It's 46,303. Then we are going to divide by the sales of 2013 because we are now in 2013. The sales for 2013 amounts to 105,000. We will multiply that by 100 over 1. Which will be 46,303 divided by our sales of 105,000. We multiply that by 100 over 1. It gives us 44, that is 44%. It gives us 44%. What does it tell us? It tells us that for every 1 rand of sale, what we got back as a business was 71% as earnings, was 71% in 2012. But the scenario changed for 2013. Now, what we are earning for every 1 rand of sale amounts only to 44%. we have a decline of 27%. We have a decline of 27%. If you could see, for the sake of consistency, I only took examples where our results are declining as compared to the previous, so that we do not create confusion. Sometimes they do increase, but I wanted to be consistent, that for everything that I'm doing, I want to show you when the results are declining in the business. Yes, sometimes you calculate it and find it that it is improving or higher than the previous year. It's fine. But I'm saying for the sake of consistency, so that you all understand and we move on an equal footing, I've used examples where the results, as when you compare them with the previous year, are declining. So what does this tells us? It tells us that for every 1 rand of sale in 2012, the business was earning 71%. A huge 71%. But for every 1 rand of sale in 2013, the business is now earning 44%. It's a decline of around 27%. We are going back to our explanations. Because it has declined, what could be the reasons? It could be due to the lower markup percentage, or expenses could have increased at a faster rate than sale. Expenses could have increased at a faster rate than sales, or it could be the interest on loan, which has an effect on the bottom line profit, or it could indicate a low margin of safety and a higher risk that a decline in sales will erase profits and result in a net loss or a negative margin in the future. The same is true because if you check this activity here, our net profit was 86,000. 86,628. It declined to 46,303. And if this scenario is allowed to continue, then the business is at the risk, because this could lead in a net loss or a negative margin. Now we are still having a positive margin because we still have profit. But if it continues if it is allowed to continue like this, we'll have a situation where now for every 1 rand of sale, there is nothing that comes back to the business. Therefore, our margin will be negative. Our margin will be negative. Let me just take another example. Let me take another example. In trying to address the question of debtors allowances and sales, I came up with this activity. These are your sales. 2,540,806 represent your sales. Let us say for the sake of argument that the 3,906 represents your debtors allowances. For the sake of argument and clarity, this represents your debtors allowances. Therefore, the amount of sale that you are going to use this side is not inclusive of debtors allowances, because debtors allowances already have been subtracted. I'm trying to respond to the question that are we using sales only, or are we taking it after we have subtracted debtors allowances? I think we have subtracted debtors allowances, therefore we are using the final figure of what we have. The net profit as a percentage of sales on this activity I'll say this is 2015. I'll come up with figures for 2014. Right. The net profit as a percentage of sale. Net profit is 2015. It's 100,014 cents. It's 100,014 rands. Over your sales of 2,536,900. You multiply that by 100 over 1. Then you'll have your 100,014 rands divide by 2,536,000. That is for sales. 536,900. We multiply by 100 over 1. That is 3,9. That is 4%. We assume, let us assume, we assume the result for 2014 were 3%. We assume the results for 2014 were 3%. Now we have an increase. The net profit as a percentage of sale has increased from 3% that I'm assuming, that I'm giving you as an assumption, to the 4% that you just calculated. It means in this scenario, although if I want to compare it with this one, although the profit percentage improved from 3% to 4%, we said the higher the margin, the higher the profit margin, the more profit a company earns on each sale. Therefore, it means for this activity, the company is earning a mere 4% of every 1 rand sold. It is earning 4% for every 1 rand sold. That will give you in terms of, in monetary terms, that is 4 cents. The company will sell an item for 1 rand, but we know the net profit of the business in that 1 rand is only 4 cents. So you see, the results are satisfactory that they have improved. They have improved from 3% to 4%. We have a 1% increase. But in terms of the net profit as a percentage of sale, the higher the profit margin, the more profit the company earns on each sale. This activity, it only tells you that the company will earn 4 cents for every 1 rand sold. Let us go back to that one. This that we calculated earlier. The 2012, the company was earning 71%. It means for every 1 rand sold, we are earning 71 cents. Yes, for everyone in monetary terms, it tells you that for every 1 rand that we are selling, our profit in that 1 rand, it's 71%. Then it declined to 44%, which says for every 1 rand of sale, we are now earning 44 cents. But these figures are too high, they are higher, acceptably high, because we said the higher the profit margin, the higher the profit margin, the more profit a company earns. So I just want to talk to this result, that when you compare, this is activity A, this is activity B, that when you compare activity A and activity B, the net profit as a percentage of sale declined from 71% to 44%. But these profit margins are acceptably high. That in activity B, the profit margin improved from 3% in 2014 to 4% in 2015. That although they've improved, but these results are too low, because it says to you that for every 1 rand that you are selling, you will sweat, you go up, you sell for 1 rand, you are earning 3 cents as a profit. That in 2015 things improved, that you are now earning 4 cents for every 1 rand. So although the ratio has improved, but we are saying they are still too low. But the higher the profit margin, the more the income or the profit that the business is earning. Let us try to touch on the operating profit of sales. Or let us just do a summary of all of them, not the only one, that is operating profit on sales. Let us try to summarize what we have been saying here so that we all understand. We said when you do profitability ratios, you must know that your information will be extracted from the income statement. There won't be a need for you to go through the question paper, even in the balance sheet, trying to find out where is the operating profit. Going line by line looking for operating profit. We need to know where our information is, because that saves us a lot of time. You'll find someone calculating, let's say, returns to shareholders for argument's sake. But you'll find the person looking for information in the income statement, looking for the information for the returns in the income statement. We are saying for the returns to the shareholders, maybe you look for at the balance sheet. The profitability of the business, you must know where to go, because that also saves you a lot of time. You are going to get that information from the income statement, that when you calculate the gross profit as a percentage of sale, net profit as a percentage of sale, and gross profit as a percentage of cost of sales, what you want to see is to determine whether the purchasing policy, the sales policy, and the markup as per management policy. Then when you calculate the net income as a percentage of sale, you want to determine the specific income of the business and overall performance of its operating, financing, and investing activities. The gross profit as a percentage of sale indicates how much profit is included in the sale of an item. The gross profit as a percentage of cost of sales indicates if there were major changes in the cost of goods sold. The operating profit on sales indicates the operating profit for every rand of sale after taking all the company costs into consideration. Then the last one that we just dealt with now is the net profit on sales, which indicates the overall performance of the business operating, financing, and investing activities. That is for every 1 rand of sale. How much is the business earning? The higher the profit margin, the more profit a company earns on each sale. This brings us to the end of this presentation. I hope that you are clear on certain aspects, and I also wish you the happy holidays. I know all of you should not be resting by now, but you should be busy at school preparing yourself for the final exams. I'm saying whatever you are doing now, the results might not be visible in a day or two, but it is building towards the final destination, that is the final examination. So please work hard and prepare yourself, and remember that what you sow during these holidays will be reaped at the end of the year. That is when you pass your exams. Looking forward to seeing you in individual schools as and when we assist one another, and hopefully we are going to stick to our targets of ensuring that accounting improves and that we reach the district targets. Thank you very much, and I wish you well. Have a super Friday. Thank you.